Welcome to enrichminds.com and 2-hour session on diversification. We have grown up being taught to never put all your eggs in one basket. That, in essence, is the importance of diversification and the importance of asset allocation. Now that we have covered risk and reward in the last session, we shall learn about diversification as a risk management strategy in today's session. Risk cannot be totally eliminated. Diversification is one strategy commonly used to manage or reduce risk. Risk management itself is an independently large subject and field of study. Let's start with a short video on diversification.
90 eggs to carry. How would you do it? Would you put all of them in one basket? Or would you carry 3 baskets with 30 eggs in each? The risk is that you drop a basket. With 3 baskets, the most you lose is only 30 eggs. But if all your eggs are in one basket, all 90 eggs might crack. Losing 90 eggs is disappointing, but not as much as losing $90,000. The principle "don't put all your eggs in one basket" holds true for investments. Investing in a healthy company can yield a generous return while everything goes well. But if the company goes bankrupt, you lose your investments as well. The key is portfolio diversification. When you mix different asset classes, you enjoy a balanced risk and a balanced portfolio volatility. Stocks, bonds, cash, real estate, mutual funds, and CFDs. In various market conditions, asset classes and their derivatives behave differently. For example, stocks are generally more volatile than bonds. A downswing in stocks can be offset by returns in the bond market. Want to invest in stock CFDs? Good. Spread across stocks of different companies, industries, countries. Minimize the up and down effect by including a blend of stocks. In negative situations, your portfolio will suffer less risk. Let's sum up. Diversification is good because it makes an investor less dependent upon one asset class. It reduces risk tied to a particular asset class. When one asset falls in value, another often rises. With all the advantages that come with portfolio diversification, please remember it doesn't eliminate risk, but it can decrease the exposure. You only spread the risk, not get rid of it entirely.
So the real question is, what is diversification? And the simple answer is that diversification is a risk management strategy and practice of dividing your money among lots of different types of investments. It's the investing version of spreading your bets. Investing is a lot like riding a roller coaster, with plenty of exhilaration and stomach-churning drops. Diversification lets you smooth out the ride. The basic idea is this: if you have different investments and the value of one falls, your other investments can help stabilize your portfolio's overall returns. How exactly does this happen? Investments don't usually move as a group. If oil is down, tech stocks might be up. Or if small company stocks are struggling, large companies could be doing well. So, if one of your investments loses value, the others might decrease less, hold their value, or even increase. You can never completely eliminate investing risk, but diversification can significantly reduce it. The more you spread out your money, the less likely a dip in one part of the market will tank your entire portfolio. Consider 2 investors' portfolios. Consider investor A, who has 100% invested in one big tech company. So, he is 100% invested and therefore exposed to how that one big tech company does. Now consider investor B. He has invested in a mix of stocks, bonds, real estate, and he has some little bit invested in the same big tech company. He is less exposed to how that one big tech company does. Now watch what happens if the big tech company suddenly suffers a 50% drop in value. Investor A's portfolio will also fall 50%. On the other hand, because Investor B has a diversified portfolio, he will only lose a little bit, assuming the portfolio's other investments hold their value. So, we can see that Investor B had a diversified portfolio and hence he did much better than Investor A. Of course, if the tech company had doubled in value, Investor A would have done a lot better than Investor B. But that is just how risk works. Risk cuts both ways, higher potential losses and higher potential gains as well. Let's now look at the benefits of diversification. Investing experts disagree about a lot of things, but they tend to agree that diversifying is a great strategy. Here are some of the advantages. First, reduced risk. The more you spread your money around, the less you stand to lose if any one or two of your investments tank. Second, smoother returns. Any one investment might rise or fall in price from year to year, but holding a broad range of investments usually reduces the bumps. Third, better chances at finding winners. Every investor wants to get in on the next Google or Amazon. The more investments you own, the better your chances of doing so. So, how do we diversify? Everyone agrees that diversification is a must for all investors, big or small. Diversification is often called the only free lunch in investing because it can reduce risk without reducing returns. Some of the best ways to diversify include, first, by asset class. Hold a mix of stocks, bonds, cash, and alternative investments. Second, by geography. The United States can be a great place to invest, but other countries' investments may offer higher returns. Third, by industry. Different industry sectors perform well in different years and economic cycles. Fourth, by issuers. For bonds, hold a mix of corporate, federal, government, and state and local government bonds. And by size of company. Small companies tend to do better during strong economic cycles, and larger companies tend to do better during recessions. Hold shares in small, medium, and big companies. The word diversification comes from the Latin words diversus, meaning turned in different ways, and faccio, meaning to make or to do. Some investors diversify with precious metals. Gold often performs well during stock market crashes when investors are looking for safe havens. Let's watch a short video on diversification, courtesy of Napkin Finance.
Diversification. Diversification is a way to minimize risk in your portfolio by spreading out your money with different types of investments, such as stocks, bonds, cash, and alternatives. There are many ways you can diversify your investment portfolio, including with asset classes by investing in a mix of stocks, bonds, and other investment types, geography by investing in stocks and bonds from different countries or regions, industry by holding investments across many different parts of the economy like technology, healthcare, and energy, company size by investing in stocks of large companies and small companies. Diversification is the financial world's version of that old saying, don't put all your eggs in one basket.
Diversification is a strategy of spreading your money around with many different investments. Because investments don't usually move as a group, diversification can help insulate you from the ups and downs of any single stock and even out your overall returns. There are many ways to diversify your investments, including by investing in different industries, geographic regions, and asset classes. Diversifying is the act of spreading your money around with many kinds of investments. The benefits of diversification can include reduced risk, better chances at holding winners, and smoother performance. You can diversify by investing in different asset classes, countries, and industries, among other ways. Our one and only simple takeaway from this session today is diversify, diversify, diversify. Thank you for your time, and until next time then, stay enriched and strong.